Hey guys, Toby Mathis here, and I'm joined by Erik Dodds. First off, welcome, Erik.
Thank you, Toby. Appreciate you
And we're
having me
going to
here.
get into, we have the Federal Reserve restart. We've got shutdowns going on. We've got all sorts of crazy stuff going on in the world. What's going to happen? We're going to look at the good, the bad, and then we're going to go over what you can do if you're scared. If you're one of those people that is really worried about what's going on, things you can do to protect yourself. So let's dive in. First off, Erik Dodds runs the trading room over Infinity Investing. Where there's people that trade every single day, and Erik leads that room. And I wanted to pick his brain and have him go over some charts to go over what are this, what is the past tell us? What do the charts tell us? What is he looking at? What is his group looking at? So that we can make heads or tails of this. So Erik, I'm going to hand it to you.
Love it. Thanks again, Toby, for having me here. Let's go over a couple things. Disclosures, of course. We're doing this for educational purposes only, and I know you're going to flash that at the beginning of this, so I'll let you work on that, Toby. This is one I stole from Carson Investment Research, Ryan Dietrich, on social media. He does a good job of putting a lot of statistics out there, and you're a stats guy. I like looking at numbers. This talks about, since very timely with looking at shutdowns right now, right? So shutdowns, drama, what really happens. He got into the political side of things a little bit, who was running things in Congress and the president at the time. But you go to the start of the shutdown, right? There's the date of the shutdown and the reopen date. So it gives the length of that. It talks about the S&P return during those time periods. So you can see that you can even have positive returns. Even though the headlines are scary, we talk in the room all the time about ignore the headlines. Headlines of a government shutdown are scary. We're 2 days in now, and the S&P 500 is at all-time highs. And if you look 12 months after the shutdown ends, 86% of the time it's higher, and the average return being about 12.7%. So while it's scary headlines, the market shrugs that off 86% of the time.
So statistically speaking, you're looking at it saying that the shutdown shouldn't cause you to run for the exit. There might be some short-term pain, as it looks like the red. I mean, average-wise over the S&P return during the shutdown, which is just over a week, typical shutdown, we're slightly up, but there's a lot of red in there too. But when you look at it afterwards, I guess the worst year you've ever seen is what, 2018, and there was 7% down. Nothing to
Yep.
speak about. Look at all
Exactly.
those just
So,
massive growth years.
yeah, little choppiness, but nothing too crazy, right? I mean, sometimes a little pullback of 3, 4, 5% is actually healthy for the market. Kind of
Okay, that
shakes
makes me
things
feel
loose a little
better.
bit and then allows the market
That makes me feel
to
better.
reengage.
All right, so
Yeah.
the shutdown. All right, hopefully by the time somebody watches this video, the shutdown's over, and now we can play. We can look at that history too.
Right. See where we're at. We can start the clock running at that point. I think the more entertaining thing is going on one of those betting sites and seeing how long the shutdown is actually going to last. Those things are out there now. That's the entertainment thing to watch, not what the market's doing.
You can make a
Um,
fortune just betting
the
on what it's going to do.
Okay, that's what I was saying the other day. As conspiracy theorists could have made a killing on some of these things out there with all the things that have come around. The other thing you mentioned was the Fed restart. So it's not, we were here about a year ago talking about the Fed rate cut and what can happen afterwards and what to look for. This is looking when the S&P 500 is at all-time highs. And this is from Blue Kurtic Market Insights off their social media. I'll mention a couple things in here that need to be cleaned up a little bit. Their data, not mine. But when the S&P 500 is all-time highs the day after the Fed rate cut, what does the market do 1 month after, 3 months after, 6 months after, 9 months after, 12 months after? And you can see here all these dates that meet that criteria. Now, this should be 2025.
Yeah, we just had
Someone
that.
maybe a little copy and paste. Again, I'm just pulling off their chart, but that should be 25 because we just did that rate cut a few weeks ago. And this, I calculated rough numbers is roughly almost 19%. Whatever the actual number is, it's still pretty good and probably comes pretty close in line to what the average has been. So that's kind of a rough estimate there of the one that happened about a year ago. So that hasn't been
We're not
updated
at a
yet.
year on the
And then
next
we
one,
have,
right?
and we're not out a year on the next one, so we don't know. But long story short, kind of just like the shutdowns, maybe a little bit of turbulence in the beginning, but certainly when you get past 9 months and you get into a year, so far running at 100% positive. So maybe there's some turbulence between now and a year from now, but a year from now, you'd expect that you get more of the same until proven otherwise, at least in this case, right? So obviously we're correcting this year here and knowing that this just happened in time here. But if you go back in time, we can certainly see that given 9 months and certainly give it a year, we've had positive returns in the S&P 500. So we'll have to look back and see where we're at come November of this year. And obviously a year from this most recent cut that we have. All things being equal, if it's going to be the same, we're going to look at market moving higher and having a positive return. On average, it's been around that 19% return, which is what I calculate an estimate of what we got roughly in the September cuts a year ago.
When you look at average and median, this is what's interesting to me. So I'm always dealing with average and median in a lot of the reporting I look at. And median's the midpoint, the 50th percentile, and average is usually skewed. So when you see like average net worth, it might be 1.2 for all people, but the median, the 50th percentile might be 190,000. And that's pretty close to being what it is. Right. They're usually way off. So what we're seeing is remarkably consistent numbers because they're not all over the place. That average, the median being slightly higher is actually really surprising, which means more often than not, you're up over 20%.
Right. Really, you only have two on there that are less than 10%. If you look at the 89 and the 91, and those are the ones that, well, the 89 one is the one that had a rough 9 months, if you want to call that rough. But yeah, everything else is really over 15%. So
wow.
Again, not 100% sure on the September, have to let the stat people really make sure they got the last year's one. But yeah, usually pretty good returns.
All right.
Pretty good outsized returns there. So
that seems to be telling us everything's great, right? Now please ruin my day. Tell me the contrarian side. Show me what's going on, why people are saying, we're in for a recession and all these things.
Well, let's talk first about interest rates and where the 10-year bond is, right? So we know that if you look long term, right, the U.S. 10-year Treasury, this is the actual yields on the 10-year Treasury, were in a run up in the 60s and 70s and peaked in the early 80s and have been we're in a long drawdown, the lower interest rate environment, zero interest rate policy, those kinds of things, until around 2021, 2022, when we bottomed. And then you saw, and you had COVID, of course, and then we shot like a cannon out of there in 2022. And we saw a peak so far in the 10-year, a little over 5% in October of 2023. Since that time, really since the end of 22, we really haven't gone anywhere. So yields have been fairly stagnant here. In fact, for the most part, from the last rate cut and even this one, some of the longer term rates have actually gone up a little bit, right? Like you haven't seen mortgage rates come down a lot, even since last September, a year ago September, when they cut rates, which is kind of the bond market saying, hey, maybe there's more under the surface that Fed you're not seeing, or just not maybe buying what the Fed is selling there. I think we're at a time where this is going to start to come down first. My opinion is that we see yields on the longer end of the curve start to come down before they go back up again later on in the decade and early into the 2030s. That's just more of a personal technical read on what's going on yields, which would be good for longer term bond prices. But what are things to look at? If we're talking about the stats that you get off of the stock market and Fed rate cuts and shutdowns, if we look at things like the yield curve and we compare the 10-year yield to the 2-year yield, and we'll look at that on say a monthly basis, this line right here, this zero line, is where the yield curve gets inverted. And what that means is you have shorter term interest rates higher than longer term interest rates, right? Which you are big into borrowing and houses and private equity and those kinds of things. You're not going to lend money for a longer period of time at a shorter shorter interest rate. So this has oftentimes, when we uninvert, when we come out of that mode, you can see here before 2020, you can see here we just uninverted, meaning this part of the yield curve is normalizing. You can see in 2007, you can go back. These red shaded areas are the NBER, the National Bureau of Economic Research. That's when they've deemed this time period to be in a recession. So the bad news is that if this is like other time periods, when we uninvert is usually a signal, a precursor to when there's a recession.
Yeah.
So you can look at different parts of the yield curve uninverting. I'll take a deep breath there, and you can.
No,
and
that's what you're hearing. A lot of people saying, "Hey, that inverted yield curve was a precursor to the recession." I guess my comment back
Right.
would be, we probably were already through a recession. There's a question as to whether we went through one, depending on how you measure it. But the interest rates weren't what they were saying.
Right.
Like, I know as a fact that housing is up 50%, and I think a dozen eggs is up 170%. Most insurances are up 30 or 40%. I'm talking about a 5-year stretch since, so I'm looking at your chart going probably since 2020. And what are they saying? That inflation was at 2 or 3%. And it's like, good luck.
Well, right. You know that they've been revising job numbers like crazy. And so, yes, there was that time period in 2022 that, and they kind of changed the definition of recession. So I'm not in disagreement. I think there was one. The question is, are we going into another one, or have we just been in this maybe rolling type recession time period, right? Where we're kind of in and out of it as it may be. But if you start to look at these spreads, yeah.
I don't want to throw one thing in there because a lot of people, they use the recession. It's the big R word, right? But how about pain? Government was inflicting pain. I think that the Fed inflicted a lot of pain on our economy, and and they say, oh, it's rolling along so well, and I'm like, for whom, right? Our debt has never been higher. Both the government at 37 trillion plus individuals are swimming in debt. Affordability is out the door for housing. Everything's gotten significantly more expensive. Wages are starting to keep up and creep up. But still, the government did a very good job of inflicting pain, or the Fed inflicted lots of pain with those high interest rates. They froze the real estate market in place. And there's a lot of folks that are probably not too pleased about it. Now, that said, what do these things tell you about the future?
Yeah, and that's what you look at the 10-year, 3-month spread, and that is coming out of an inversion. The one that isn't yet, but has usually been a pretty good indicator. I mean, it has propped up a little bit earlier in the year, but you have the 2-year yield and the Fed funds rate. And that you can see usually when that does uninvert, we're already kind of in a recession there. So this is, I don't know, the last shoe to drop, if you want to say. But the market has shrugged off a lot of this, right? The only thing we've really seen this year in the market where it really hasn't liked is the tariff announcement. And I think the market is I'm usually more concerned about the market from a liquidity standpoint and from a confusion standpoint. If there's confusion or lack of liquidity, that's usually what the market doesn't like. Other than that, it's kind of full steam ahead. But these are some things that, big picture wise, you can look at and say, hey, maybe this is something to pay attention to. Mm-hmm. One other chart real quick, just in keeping with interest rates, is something to pay attention to is as maybe a risk on, risk off, is if you look at corporate bond, you look at the high yield, which is your riskier corporate bonds relative to your investment grade or safer corporate bonds. This ratio has been in a very strong uptrend. If this starts to falter a little bit, that might be a little bit of a risk off scenario too, just kind of in the interest rate theme that we tend to pay attention to.
Isn't that a little euphoric? When I see these are junk bonds, I guess, that just seems like
it's junk bonds versus, yep, it is. It's junk bonds versus the safer corporate bonds.
And we're a little bit wonky right now, right? Because why would you?
Well, euphoric's a great term.
Yeah, I'm sorry to interrupt you, but it's the idea of like, why would I go after a junk bond when I can make 4.5% without the risk?
Right. Yep. No, you're on point. There hasn't been much difference in the spreads between the junk and the corporates. Another thing that's hot topic right now is gold. This ETF GLD. This is a way that you can actively trade gold in the stock market. Kind of like if you were in Bitcoin, there's Bitcoin ETFs now that you could trade.
Mhm.
So this mimics the price of. You can see that this has gone parabolic. Now there's various theories on why this is doing what it's doing. One would be inflation, right? Your real yields, which is your interest rates minus your inflation. If those are running negative, people are going to look to gold to help kind of a store of value and keep pace with inflation. And gold has had a fantastic year this year. So of silver, so of the miners, the metals, the miners,
We're
those kinds of things.
we're going to be
So
printing more money. Everybody knows what's going on. 37 trillion.
yep.
The government's not stopping their spending. Maybe with the shutdown they're going to cut, but it's a drop in the bucket. So gold's been going nuts. I'm not a big fan of things that don't pay me though. So I always put that in my I use the
Yeah.
30 30 30 10, the 10% buckets for cash or cash equivalents, and that's where my gold goes.
Yep.
Um, but what is that telling you? Is it telling you that we're going to continue with inflation, even though we're lowering interest rates, but this is telling me that inflation's ramping, is continuing to march at a higher amount.
It could be inflation really hasn't been the boogeyman since 23. And they started cutting last year. I don't think inflation was really the boogeyman then either. If you look at something like trueflation, which is a nice metric that shows that's inflation right now has been on the decline to a degree. Obviously, we know there's a lot of things that we all see, and you can see those charts
I'm just
there.
gonna go
I don't know
through.
if it's,
Here, gasoline is
yeah,
up 42%. Pound of coffee is up 97%. Dozen eggs is up 170%. Auto insurance is up 60%. This is over the last 5 years, guys. Fuel oil up
yeah.
55%. Gas utilities up 54%. Home prices 51%. Transportation 40%. So they can say whatever they want. Groceries up 25%. Used cars are still up 27%. It's not what they're saying, but we know that.
But I don't know if this is all entirely inflation. It could be. If you look at the chart of the dollar's been clobbered this year, one of the worst years, if not maybe one of the worst year you've had percentage wise in the dollar. The DXY,
Mm-hmm.
that chart has not been very good. So that's
It's the opposite of this
helping
chart.
gold.
The US dollar has
Correct,
just been getting
exactly.
beat on for the last 50, 60 years. It's just getting crushed.
Which is something else to pay attention to. If the dollar does rally here, that could be another thing to pay attention to in the market. But
Yeah.
I mean, gold's it's been strong. I think there's a geopolitical undertone to it as well, and there's just a technical. This thing, on this monthly chart, this thing has been in a base for the better part of a decade. So you're getting all
Mm-hmm.
of this energy in the charts that's moving it higher here. It just and the theme behind it certainly is inflation and maybe some
And folks, we're going to get
geopolitical
into what you
underpinning.
can do. I'm going to pick Erik's brain as to what he's doing with his trading group, what you can do to protect yourself. Because again, we have the good, the bad. The good is saying like it's almost an 80% certainty that you're going to be up in a year from now. The bad is, but for some reason we're peaking. I would love to see what the valuation of the SPY and the Buffett indicator. I'm sure that they're just screaming that
Yeah. So
we need an adjustment. Market's going to crash. I'm sure that's
yeah. Well, if you look at that, that's at all time high. So the Buffett indicator, take the S&P 500 divided by the GDP, gross domestic product, and you can see this is at all time highs. And it's certainly been a point when we've been at all time highs that you can have some down, but right now it's what goes high is going higher, right? I mean, we broke through all time highs a couple months ago and we're still pushing higher.
I
So
believe statistically speaking, that's true. When the S&P makes new highs, you're actually more likely to create more highs than any other time in the market. So a lot of people that say like, oh my gosh, the SPY is at its high. It's time to sell. It's going to adjust. Statistically, that's not in your favor, right?
right, but you're also not that far off the highs. Like you might be down 1% and then you get up 2%. So, but yeah, it can keep stacking on things. And there's nothing on the charts right now that is saying there's a crash coming. The only thing that's a little bit of a head scratcher right now is if you look at, say, SPY, which is, again, your stock market S&P 500, and that's at all-time highs, and that you can see on a monthly basis since April has been going to the moon and all-time highs. And then you have the VIX, which is a measure of volatility in the S&P 500. And that, interestingly enough, especially if you look at shorter term charts like the weekly chart, has been making some higher lows. These are two things. The S&P 500 and VIX are almost a perfect marriage of inverse correlations. And the fact that they're kind of going in the same direction, you're not having VIX go down and make lower lows while the S&P is continuing to make all-time highs, is a bit of a head scratcher and will resolve itself in either VIX, headed back down into the low teens or even single digits where it's been before, or you're going to see it correct itself in a way where the S&P 500 has a good move down and shakes out this strange correlation we've been seeing here recently.
Perfect. All right, Erik, we went through a bunch of charts. I'm going to say let's stop with the charts and let's go over what are some things people do. Maybe
Sure.
there's three things that your people are doing that you would suggest people do if they're freaked out. Like maybe you think it's going to go great, it's going to keep going up. Perfect. What are some things that they can do? What if you're scared to death and you think there's going to be a correction? What are some things you can do to protect yourself? And I want to just let you have the rest of the time just to go over those.
Sure. I'll hit on, let's say, three simple things. None of these are advice, and maybe they're not all great. Like the first one that comes to mind would be if you're really scared, you could put it in cash. But you just went over the problems of doing that, right? We still have inflation out there, the price of eggs, gas, all those kinds of things. Not to mention there may be some tax liabilities in there that you might not want to incur. So I don't know that hiding in cash is the best thing right now, outright. Although you could look at Buffett and he's got a lot of money sitting in cash right now, and he's done a good job in the past of kind of timing these things. I don't know if that works for the average investor. But the second thing you could do, or a thing that you could do, is you could sell some of your upside potential by selling a covered call. If you have shares of stock or an index or a fund that allows you to do that, you can sell a call against the upside, which would generate some cash flow. And you could use that cash flow to buy insurance on the downside to protect your downside, so that if the market fell precipitously and was at or your stock fell and was a lot lower than the protection that you bought, you'd have a right to sell your shares at that higher price. So it gives you that kind of protection in these nervous times. Third, so there's some complexities to that to a degree. We certainly talk about those in the rooms a lot, and we bring up callers almost on a daily basis and how you protect your portfolio and the trades that you're doing. The third would be to maybe mechanically, or if you want to strategically, if you feel like these indicators are screaming red, but you don't want to sell, you could just buy some put structures, buy some out of the money puts on the S&P 500 or something like that, something that correlates highly to your portfolio, and those would likely gain in value if the market goes down. One thing I would look at on that is, maybe not like a week out or 3 days out, not trying to time these short-term blips, but, buying them out a little bit further in time. So there's some value potentially to those puts if there is a market downturn. So there's the beautiful thing about the market is we can very simply protect ourselves in what we have and not have to be forced to sell if we don't want to, but still have some protection.
And just for folks that don't know what these things are, like selling a call is the right for someone to buy your stock at a price. And if you're out of the money, you're selling it for a greater price than what you paid. And a put is is allowing you to force someone to buy your stock at a price, and you're paying them for that right. And you can buy them a year out. Like if you're really scared, might cost you a little bit. It's insurance. It's going to have a premium to it. But this way, if the market tanks, you're protected. So, so there's a couple of things. I appreciate that. What I would say for folks, if you want to learn that vernacular, if you want to learn that language, I'll put a link into the show notes for Infinity Investing. You can go in there, and Erik does a free class periodically, I think about every other week or at least once a month, depending on how often we can get him. And he
Yep.
teaches something called the wheel strategy. What are dividend kings? What are aristocrats? Why we're bullish on them? These are companies that they've been through recessions, and they continue to pay their shareholders an increasing amount every year for 25 years, and in the case of aristocrats, for 50 years in the case of kings. And Erik shows you how to buy them by getting paid, and get paid while you own them, and get paid when you exit. It's multiple streams of income off of stocks. And so I would recommend that you highly go there and check it out. Erik, we're about time. I just want to say thank you for coming and sharing. And would you be willing to look at the comments in case people have questions when we post this, and go in there and answer their questions?
Yeah, I'd love it. Any questions that come up, and I thank you again for having me here, and for the start writing the Infinity Investing book, and having me in the rooms. Appreciate
Perfect.
it.
Appreciate it.